Adobe will release second quarter results after the close on Tuesday, and to prepare for the release, we're going to run through our usual analysis of comparing consensus estimates to management's guidance. So there are a few things that we'll be watching for this quarter. First, the continued migration for the Creative Cloud to a more subscription-based model. And then in the video space, we see continued adoption from large-scale production companies as well as individuals and websites for video. So this should continue into the future. And then the third thing that we'll be looking for is details on the installed base in the past couple of quarters. This has grown pretty significantly, and that's been due in part to new mobile apps, which provide significant future cross-selling potential. So these trends will probably continue in the second quarter and into the next couple of quarters. So it's really an exciting time to watch Adobe. So for the guidance, we're going to take the details out of the fiscal first quarter earnings slide. So this is available on the company's investor relations page. And if you scroll down to page 13, that's where their outlook starts, right here. And we'll be plugging those details into our earnings model, which is available for download on our website, gutenbergresearch.com. Click the Models tab, scroll down to Adobe, which is now the first company in the list of models. Click the icon to download. And this model was actually developed by one of our financial modeling interns, Lindsay Yonish from Northeastern University. And Lindsay developed this model, and she'll also be providing the updates to this model Tuesday after the company releases results. So be sure to check back on our website for Lindsay's updated model. And she's also provided a preview note, which is available on the news tab on our website. So definitely check that out. It's got a few things that we should be watching for this quarter. So since this is a new model, we should just take a few minutes to get grounded in how the model works. The methodology is very similar to the others. All the columns that have the light gray headings represent the future periods, and the dark gray headings represent the historic actual results. The orange cells show that the metric is calibrated to meet consensus estimates, and the purple cells represent management's guidance, so no change there. The model starts with the income statement, which is modeled both on a GAAP and non-GAAP basis. Below that, we have the segment details, and you can see that Lindsay has basically provided breakdown, the same methodology of segmentation that management gives. So you have details for the digital media segment, the digital marketing segment, and then the print and publishing segment. Below that, we have some ratio analysis, which will be used to fill out the rest of the income statement. Then we have the non-GAAP adjustments and change in total shares. And then Lindsay has provided a balance sheet and cash flow statement for the historic results, which are collapsed, but you can uncollapse them by hitting this button. And then since this is a tier 2 model, we're using a multiple base valuation approach. So we have the details of that here, as well as our risk estimation metrics. So we're essentially using 2 standard deviations in the monthly returns, using historic values to come up with our implied target price band around our price target. So essentially, it's pretty similar to the other models that we look at. So let's go through the guidance that management provided now. So let's go back to the details of guidance that they provided in their earnings call from last quarter. So first of all, they just mentioned that there was an extra week of revenue in the first quarter, and that had an impact of about $75 million. So if you're going to look at results on a sequential basis, you should just keep that in mind for the second quarter. Next, they give total top line second quarter revenue estimate of $1.365 billion to $1.415 billion. So let's take a look at our model here. And you can see that Lindsay provided that details in her comment. And the total consensus revenue results came in at about 1.4. So kind of the high end of management's range, but still within that guided range. Next, they give some details by segment. So here they say in digital media, we expect to add approximately $275 million of new digital media annualized recurring revenue. So the recurring revenue metric is something that they actually started giving guidance for in the first quarter. So we haven't actually incorporated the recurring revenue separated from basic other revenue. in our model, but it's something that we could include going forward. So we may actually change our model to include that. But other than that, they just say that they expect strong year-over-year digital media segment revenue growth. So if you take a look at what we did for the digital media revenue, so on a quarter-over-quarter basis, we're expecting about 1.3% growth, which that's consistent with the fact that there was that extra week in the first quarter, and year-over-year, this is a much stronger growth metric because in the May 15th quarter, we were looking at revenue of about 750 million or so, and now we're like close to 950 million. So very strong growth year over year here. And in terms of gross margin, they don't give details on gross margin on a segment basis, but we're saying that it should be somewhat consistent with the gross margin we saw in the first quarter of about 94%. So that's what we put for the digital media segment. Next, we can take a look at the digital marketing segment. So here, they said that they expect the marketing cloud quarterly year-over-year revenue growth to fluctuate below and above the annual fiscal 16 target of approximately 20%. And then they give some kind of clarity on what that fluctuation might look like. They say, given this, we are targeting approximately 17% year-over-year Adobe Marketing Cloud revenue growth in the second quarter, with continued bookings momentum throughout the rest of the year. And obviously, if they're targeting 17% in the second quarter, you would expect to see much higher momentum and much higher growth in the back half of the year. Otherwise, they wouldn't hit that 20% total fiscal year 16 target. So we've incorporated these details into the digital marketing segment, and you can see that we've provided some further disaggregation of this segment, since that's where a lot of the action is here. Not quite the contributor of total earnings that we see from digital media, but in the future, it's likely to have a greater overall impact on results. So here in the Adobe Marketing Cloud revenue segment, we've got 17% year-over-year growth rates for the May quarter, which is in line with that guidance. And then we're saying that in the August quarter, it's going to be similar to that 17%, with a big pickup in the fourth quarter of 2016 to reach that ultimate 20% full year 16 guided range. So there's still not a whole lot of clarity on the August quarter, what exactly will happen there. But we should get some further details on Tuesday after the call. So definitely watch for that. And then finally, in print and publishing, management doesn't actually give any specific guidance here. This is not a huge contributor to overall earnings. If you look at what the revenue is, we're expecting about 45 million, consistent with the first quarter of this year. And, overall, it's just not a significant contributor to overall revenue. So that's partially why management has not provided any details there. And then if we just scroll back, I think the tax might be the last item that they provided details for. Okay, they give some details for the share count, operating expenses, and tax rate of 23% on a GAAP basis and 21% on a non-GAAP basis. So if we scroll back here, you see that we just hit that 23% for the second quarter, and we just calibrated that to meet management's guidance exactly. One other thing to note here, if you look at this, if you look at the last quarter of last year and the full year at 25 and 28% effective tax rates, and then you look at February, you're probably scratching your head to see why it dropped so much to 13% and then it's back up to 23%. Just keep in mind that this was due to the retroactive reinstatement of the 2015 R&D tax credit, which Congress passed in December, and that impact came through in the first quarter of this year. So that's why the effective tax rate looks so much lower. That's just artificially low because of that item. So now we can round out the income statement here with that guidance that management provided for the diluted share count between 506 and 508 million. So based on our share repurchase assumptions and growth rates, which are somewhat consistent with the last couple of quarters, so we're expecting share repurchases of about 150 million versus 133 last quarter. at a price of about $100 per share, which would retire about 1.5 million shares. And that's how we got back to our total share count for the May quarter. And then they gave some guidance on estimated EPS between 42 and 48 cents per share. And the consensus on a non-GAAP basis is looking for 68 cents, which is in line with management's total guidance of 64 to 70 cents. So overall, we would say that the consensus estimates are in line with management's guidance and probably a little closer to the high end of management's range. Now, if you disagree with what the consensus estimates are, feel free to download this model and plug in your own estimates. So, for example, if you think that the digital media revenue growth rates are too low in our model, you could just plug in higher rates. Simple as that. And you'd see what the impact, you can see that this is a working model, so you can see right away what the impact is on total earnings and share valuation. You can change the SG&A, general administrative expense as a percentage of total revenue, or the R&D, or any of the OPEX items. You can change our non-GAAP assumptions, change our share growth rates or repurchase assumptions. So all of these items in blue are very easy to change, and you'd see instantly what the impact on earnings would be. So be sure to check that out, and also check back with us Tuesday after the close. We'll update this model and post it to our website. Thanks for watching, and good luck with earnings.